Okay, ladies and gentlemen, welcome to our next special edition of our Basel IV-Channel. Our previous special editions had the focus mostly on the interdependencies between IFRS 9 and Basel IV or regulatory requirements. Today's special edition has a quite different focus, but a quite important focus. We will first focus on the impact of Basel IV on the risk-weighted asset itself. And the second focus is the strategic implication and also the possible responses. The title of today's Basel IV-Channel is The Expected Impact and the Strategic Implications for Banks. So please give me the opportunity to introduce myself. My name is Neisen. I'm a partner in PwC Germany, Frankfurt office, leading there the regulatory management department. And apart from that, I'm also leading our global Basel IV initiative. Today, I'm again not alone. I have two really good experts on this topic with me. The first one is Philipp Wackerbeck. Philipp, would you like to introduce yourself?
Yes, sure. Thanks, Martin. Philipp Wackerbeck is my name. I'm a partner with Strategy N. That's PwC's strategy consulting business. I'm leading our financial services business in Germany, Switzerland, and Austria, and I'm the global lead for our Basel IV strategy and capital impact workstream. And my name is Jeroen.
Yeah, Jeroen, go introduce yourself.
My name is Jeroen Crijns. I'm a director with Strategy N based in Amsterdam, the Netherlands. I'm a specialist in financial services, especially in risk, capital, and regulation topics, and obviously heavily involved in the Basel IV topic in broader sense, and especially in the capital impact and the strategic implications of it, together with Philipp.
Okay, great. Thanks, Jeroen. Thanks, Philipp. When we started the whole Basel IV initiative and also this Basel IV-Channel, we had the challenge that officially Basel IV does not exist. So therefore, there was always the competition between the supervisors and also the banking industry, that the supervisors denied the existence of Basel IV, while the banks always were talking about the implications and the challenges of Basel IV. Now, almost 1 year after, I think the term Basel IV is used quite widely, and especially we see very often articles in the press, in the financial press, about Basel IV, and also that Basel IV is causing so much headache to banks. Here on slide number 2, we have some examples regarding these press releases and press articles. I will not go through them in detail, but one thing they all have in common. They have in common that first, the impact on the risk-weighted assets is quite huge. So in some cases, we estimated that there's an increase in the risk-weighted assets of more than 50 up to 100%, depending on the business model of the banks. And also that the strategic implications might be very big. Therefore, some banks might have to change their business models. But I think it's time to go more into details, and I would like to hand over with the start of the presentation. Jeroen.
Thank you, Martin. I think by now the Basel IV topic is, I guess, familiar to most of the people in the audience. And obviously, we have published many videos already on the topic on our YouTube channel, so I would encourage anybody to view them to get more of the details around the specific reforms that are proposed. I think just for kind of as basis for the capital impact discussion and the strategic implications, I think it's important to mention that it is obviously a review of the way that the RWA is calculated for banks, which is obviously the basis for the capital requirements. And the BCBS is aiming to reduce the variability in RWA and to reduce the model risks from the use of internal models. And the means that they are using is mainly restricting the use of internal models. So, for example, for operational risk, the standardized approach will become mandatory, and the other way is by means of input floors and output floors. I guess, yeah, that is on a high level. Again, for the details, I'm pleased to refer to any of the videos that have been already published on this topic on our PwC YouTube channel on Basel IV. Today, we would like to cover a recent study from us around the capital implications and the strategic implications of the topic. And this study, which you can find on the Strategy and the global website, is based actually on three main pillars. The first is obviously the current RWA as we're observing it with the European banks, and we've used the 131 banks that have also been included in the EBA transparency exercise as basis for our analysis. And we have combined this with our market insights on the capital impact. In the past years, we have monitored all impact studies that have been published, and with the kind of a wisdom of the crowd's insights, we have come up with an impact estimate for ourselves on key elements. And obviously, we have edited with a third pillar, which is our own analysis on the topic. I think all in all, this leads to the impact picture. Which you can also view in our study. And this, to clarify, is based on on the impact study that is based on the currently published consultation papers from the BCBS. So it's important that this is, that this is already a bit outdated to some extent, but it's based on the papers that have been published in spring of last year. All in all, obviously, credit risk has the largest impact, heavily driven by the fact that this is also in the baseline, 85% consists of credit risk RWA, but relatively, I think the other elements also add to it. All in all, the picture obviously doesn't look too pretty, and this is also something that the regulators have noticed as they have been doing the quantitative impact studies in the past year. And I think this is also a means for them to somehow, what they have seen, that some elements that they have proposed really led to significant capital increases, which is not what they have intended, and therefore some adjustments have been proposed. And I think, obviously, it's fair to say that also here we are a little bit dependent on the rumors in the market. We are obviously not involved in the process at the committee level, at the BCBS level. But I think there is a lot of rumors around it where the discussion is heading, and somehow we have here on this slide bundled where we have heard that the discussion is going and where somehow consensus is in the market where the discussion is going. So the biggest adjustments or main adjustments obviously on credit risk, also because as we saw on the previous slide, most impact is for credit risk. Kind of key changes is that the foundation IRB approach will be allowed for banks, other financial institutions, and the largest corporates, instead of the mandatory application of the standardized approach. Some elements have been recalibrated to also reduce the impact, so the scaling factor, the LGD for unsecured corporates, and the input floor for the mortgage LGD, and for specialized lending, finally, the IRB slotting approach will be adjusted to also have more risk sensitivity. For the standardized approach for credit risk, I think the key change, next to a number of recalibrations, is that the loan splitting approach will be allowed for mortgages at national discretion. So this might also impact the RWA to a large extent for some countries. For operational risk, the internal loss multiplier will allow it to be set at national discretion and could therefore also be set at 1, which implies that only the basic indicator would have an impact, which is similar to the current approach, to current standardized approach, and as such, it would not have an impact for operational risk anymore. And finally, the capital output floor. The range in calibration has been narrowed down a bit to 70 to 80%, still under discussion. And I think that the big gain is that it has been agreed that it will be applied on overall RWA level rather than on individual risk elements, which obviously have a higher impact than if it's on overall RWA level, because there is now also a compensating effect from the elements that are mandatory on the standardized approach. All in all, this will significantly reduce the impact according to our estimates, and especially for credit risk, again, this will have a much lower impact. Obviously, the total RWA is still expected to increase with 15 to 25% on average for the banks, which still can be seen as a significant increase, and still will lead also to capital shortfalls, which Philipp will talk a bit more about in a minute. In terms of asset classes that will be most impacted, it will still be the large corporates who show most impact, also because it is by far the largest asset class. But as we can see on this slide, especially for mortgages and for banks, the impact has been reduced significantly, and I think the variation has decreased significantly. So that's where it stands. Now I would like to hand over to Philipp.
Yeah, thanks very much, Jeroen. Moving on to page 9, and moving on to the capital impact this might have. As Jeroen very well described, the RWA impact has come down significantly with the most recently discussed compromise. Nevertheless, it's still a significant increase for the European banks. We've been looking at in our sample here, the 130 banks in the DA exercise, transparency exercise. What is important to know before we move into the capital impact in detail and looking into the numbers is that we need to consider this kind of double whammy effect of not just an RWA increase that comes with the Basel IV application, but also one needs to keep in mind that capital requirements increase based on the introduction of additional capital buffers for systemically important banks, for example, capital conservation buffers, countercyclical buffers, and so on. So assuming that there's an additional capital requirement of around 2% coming up, this would need to be factored in, and that's why we're showing this compound effect, which sometimes doesn't get the attention it deserves, actually. So this needs to be kept in mind when we talk about capital implications as well. Moving on then to the concrete results of our study, and this is now based on the basically updated analysis on the compromise proposals. What does it mean in terms of capital impact, this expected RWA increase? It shows that there is a number of banks that will have end up with a capital shortfall out of our sample, meaning that when you look at the graph, about 69 to 89, roughly 70 to 90 banks will end up potentially with a capital shortfall, depending on whether we end up with a lower or higher impact. Adding up all these numbers will lead to a total shortfall of capital of around between 160 and 260 billion, which is pretty significant. And yeah, looking at the average shortfall per bank range between 2 to 3 billion, which is despite the fact that, and Jeroen described it very well when he was showing how the impact came down on the RWA side, still a pretty significant impact potentially on banks. Moving on to page 11, what would that mean? Ceteris paribus, so if that capital impact would be factored in, the pro forma CET1 ratio on our group would come down from 13.4 to around 11, so between 10.7 and 11.5. Return on equity would come down also significantly from 7.5 to around 7, 6.7 to 7.0. And that, keep in mind, that is only for the banks that do have a capital shortfall, not for the ones that are obviously well capitalized after the implication. It would take quite some time to recoup that with retained earnings, so banks wouldn't be able to pay any dividend, and it takes between 3 and 4 years to make up for that difference, or significant additional reduction of costs would be required to do so. So having that in mind, and moving on to page 12, this hits the banks in a phase where they already challenged with significant profitability issues, and that is what you see on page 12. What you see here is, and it is an analysis. It's now a different group of banks, because here we've taken the 46 banks that are publicly listed in Europe and part of the stocks index. What you see is the economic spread, where we've taken return on equity minus cost of equity, and you see that for the vast majority of banks, this is negative. The economic spread is negative, so you could also say that those banks are technically destroying value, and there are only a handful of banks, mostly in the Nordics, that have a positive economic spread. So this is a very consistent picture, by the way, for the last couple of years. It's a structural issue of the European banking system, and any additional impact Basel IV might bring to banks will thus put even more pressure on banks to improve their overall profitability levels. What are now, on a very high level, our recommendations how to deal with that? A couple of strategic responses, 4 of them on a higher level laid out on page 13. One is obviously on capital management, so there are different levers to do in order to increase the required capital. Ideally, and we come to that in a second, is by utilizing a bank's balance sheet in a smarter way. Similar to that is the portfolio composition. There might be implications focusing how you compose your portfolio going forward, especially factoring in the relative attractiveness of how risk weightings are allocated to certain asset classes and putting that in line with your business plans. Similarly, on the product structure, there is potential, and banks need to, from our perspective, need to look more closely into adopting products and product pricing to also reflect the different incentives Basel IV sets to as a risk driver, and this will clearly have implications on the way certain products are priced, or if certain products are offered at all in certain markets or to certain clients. And then finally, especially for the larger, more international bank, there's a lot of streamlining potential on the legal entity structure. There have been many initiatives underway quite recently. It's not an easy topic to address. We for sure understand that. Nevertheless, if the pressure is increasing, then there will be more pressure put also on further optimizing the legal entity structure. Lastly, and that is basically somehow summarizing our views on strategic consequences. We believe that the I would say structural profitability issue of the wider banking sector in Europe, together with the Basel IV proposals, no matter to which extent in detail they will apply and whatever the timeline is, will need or will force banks to think more thoroughly about along two dimensions. And one dimension is the reduction of the balance sheet intensity, so the classical buy and hold model many banks are still operating in is not something that will continue to work well in a low interest rate, higher RWA, stronger capital impact world. So banks need to think more smartly on which assets they want to take on their books and for how long. And if they decide to move more towards the, I would say, enhanced originate to distribute models, then the question is how can this be done in a top-line preserving way, so other than the securitization. And the second element banks need to think more about is the integration of the bank value chain, or better said, the decomposition of the bank value chain. The integration of the value chain is still very high. Banks are doing a lot of the elements of their value chain still on its own, so we'll see a fundamentally different picture where banks collaborate more. Utilities that many banks use for non-critical activities will come more on vogue, and there will be other ways of thinking about the composition of the cost structure that get more and more relevant. And this is how, on a very high level, the future business model of banks will be changing. We've seen many institutions already who start working into those directions, and we believe many more will be following in that way. So having said that, we'll, happy to take additional questions or comments from your side afterwards by email or telephone, but for the moment, we'd like to thank you for your attention, and please reach out to any of us in case you have any questions, feedback, or comments you might want to share with us. And so thank you very much from our side, and have a nice day.
Thank you very much, Philipp. Thank you very much, Jeroen. I think that was a really, really interesting presentation, and it's really incredible how big the impact of the new Basel IV rules might be for some of the banks, depending on their business model and also depending on which kind of models or methods they use for the calculation of risk-weighted assets. And I think it shows also how important it is that banks have to consider responding strategically to these challenges. And to respond in the right way, I think the most important step for the banks is to perform individual test calculations, because as we have seen based on the study that Jeroen and Philipp were presenting, the impact is big, but there's a lot of variation and therefore we as PwC and Strategy and we recommend definitely to perform a more detailed test calculation for that you know what actually the risk-weighted assets impact for your organization is. And I also would like to remind you that PwC and Strategy and in the Global Basel IV initiative, we developed a couple of tools for these test calculations, and we cover with these tools all changes coming from Basel IV. So no matter if we're talking about market risk, the fundamental review of the trading book, or credit risk, no matter it's standardized approach or IRB, we have the fitting tools for that. So if you have the need for performing these test calculations, please reach out to us, or please reach out to Philipp and Jeroen if you have further questions regarding this study and the strategic implications. Thanks a lot, Philipp, again, and thanks a lot, Jeroen, again. It was a great presentation, and yeah, I'm already looking forward for the next regulatory Basel IV channel. Thanks a lot. Bye.